Welcome to the Explainer. All right, today we're breaking down 15 absolutely fascinating, mathematically backed strategies to actually reach early financial independence. To make this super clear and, easy to follow, we're going to anchor all of our math today to a hypothetical person making exactly $100,000 a year. But as we go through the numbers, just keep your own income in the back of your mind so you can see exactly where you might land. I think most people just assume early retirement is this one-size-fits-all generic path. Like you just pinch pennies for decades and then eventually you're allowed to stop working. But what if I told you there isn't just one way, but 15? Seriously, 15. Today, we're mapping out a highly customizable 0 to 30-year menu of options. So whether you want to hustle really hard for 3 years or take it nice and easy for 30, there's a specific blueprint with your name on it. Okay, let's dive into this. Here's our roadmap for today. We'll be tracking these 15 strategies across 5 distinct eras, starting with the early retirement baseline, moving to the fast-track strategies, exploring semi-retirement and relocation, shifting to cash flow and dividends, and finally playing the long game strategies. Let's start right at the foundation with Section 1, the early retirement baseline. This is basically the OG traditional financial independence recipe that we'll use to measure all the other strategies against. So this traditional baseline stems from the famous 4% rule. Decades ago, this financial advisor named William Bingen dug into historical market data. He found that if you invest in low-cost index funds, you can safely withdraw 4% of your portfolio every single year without ever running out of cash. The bedrock math here, it's pretty simple. You need to save 30 to 50% of your income until your portfolio hits exactly 25 times your desired annual expenses. Meaning, if you want to live on 40 grand a year, you literally need exactly $1 million invested. Let's anchor this to our timeline. For our hypothetical $100,000 earner, assuming standard market returns and savings rates, this baseline traditional FIRE strategy takes about 15 to 18 years. So we're going to drop a pin right around year 16. Keep that in mind because that is our baseline to beat. Which brings us to Section 2, the fast-track strategies. To actually beat that 16-year baseline, our earner is going to have to embrace either some extreme volatility or, some pretty intense lifestyle sacrifices. Let's see how fast we can really go here. Now, what's really interesting about this slide is how incredibly fast these first 4 strategies can actually get you out of the traditional 9 to 5. The absolute quickest one, Entrepreneur FIRE, landing way down at year 3. The idea is, instead of saving, you build a scalable business and then sell it for a massive lump sum. We're talking $1.5 to $2 million. It is the fastest path, absolutely, but it comes with a massive asterisk. It is immensely volatile and risky. You might catch lightning in a bottle, sure, or you might literally make nothing at all. Now, if you want something a bit more predictable, take a look at the contrasts between Coast FIRE and digital Nomad FIRE. With Coast FIRE, you sacrifice heavily early on, basically front-loading your savings for 5 to 10 years until you hit this compound interest checkpoint. Then you just stop saving entirely and grab a low-stress, chill job just to cover your daily expenses while your investments do the heavy lifting in the background. Digital Nomad FIRE, on the other hand, prioritizes immediate lifestyle flexibility. You travel the globe, work on your own terms, and you get that freedom without ever fully stopping work. And then, right at year 9, we have Extreme Frugality FIRE. Honestly, this one requires living on just 25 to 30% of your income. You're shopping at budget supermarkets, probably living in a tiny shoebox apartment with a couple roommates, and ruthlessly cutting out every extra expense. I hope you really, really like rice and beans. Because if you can live on just $30,000 a year, your target nest egg drops to just $750 grand. But the trade-off is intense. You have to maintain that highly restricted lifestyle indefinitely. Okay, if eating rice and beans in a tiny room forever doesn't exactly sound appealing, let's move right along to Section 3, semi-retirement and relocation. This is kind of the middle path where we creatively hack the system. Here we enter the year 10 to 15 stretch on our timeline. This is where a $100,000 earner can leverage part-time work or cheaper living environments to cross the finish line just before our traditional year 16 baseline. The first hacks in this era are Barista and Hybrid FIRE. With Barista FIRE, you ditch the high-stress corporate grind early and just take a part-time job, like pouring coffee at Starbucks or maybe working at a golf course where you score free tee times. Your investments cover the bulk of your life, but that part-time gig bridges the gap and here's the absolute golden nugget. It crucially provides employers subsidized health insurance. Hybrid FIRE is super similar, but instead of a customer-facing job, you use your professional knowledge to consult or freelance for, maybe just a few months out of the year. Next up, we have geographic leveraging. Geo Arbitrage basically means keeping your high-paying San Francisco or New York salary but relocating domestically to a much cheaper state like Montana. Expat FIRE takes this a whole step further. We're talking a permanent, legal move to a cheaper country like Portugal or Thailand. You get residency, set up banking, navigate their healthcare, and suddenly a super high quality of life costs a fraction of what it did back home. That drastically lowers the amount of money you actually need invested. And this brilliantly illustrates the value of waiting just a bit longer. Earlier, we looked at extreme frugality FIRE at year 9. But if you hold out until year 14 or 15, you hit lean FIRE. Just by bumping up your target budget to $40,000 a year, you buy a significantly more sustainable, comfortable life. No, you aren't living in total luxury, but you have room for a gym membership, a nice dinner out every now and then, and some budget travel. It's a massive comfort upgrade for just a few more years of saving. Now, let's shift gears entirely with Section 4, cash flow and dividends. Up until now, everything has relied on selling off parts of your portfolio using that 4% rule. But this era, it is all about pure asset-based income generation. Looking back at our timeline, these cash flow strategies actually extend past our traditional year 16 baseline, spanning from year 15 all the way out to year 22. So the crucial point here is really understanding the trade-offs of real estate FIRE, which usually involves a tactic called house hacking. The massive pro is leverage. You use the bank's money through low down payment FHA loans to buy a multifamily property, live in one unit, and literally have your tenants pay the mortgage for you. Then you just rinse and repeat. But the severe con? Actually, scratch that. It's more of a reality check. You are essentially trading your career to become a landlord. You're the one dealing with empty units, eating into your cash flow, and yep, you're the one plunging a broken washing machine at 2 in the morning.
Now, if being a landlord sounds absolutely terrible to you, there's always Dividend Fire. Here, you build a massive portfolio of dividend-paying stocks and live entirely off the passive income. You literally never sell a single underlying share. For our $100,000 earner, this takes about 22 years to build up. Sure, it's slower than traditional FIRE, but it offers immense psychological safety and way lower volatility because you never have to watch your principal balance drop when you need cash.
Finally, we reach Section 5, the long game strategies. These are definitely meant for those who prioritize maximum sustainability, total comfort, or just massive luxury over racing to the finish line as fast as humanly possible. This is the ultimate marathon stretch of our timeline. We're looking far into the horizon here, past year 25 and moving well beyond year 30. In this era, we've got pension FIRE versus slow FIRE. Now, pension FIRE actually has nothing to do with stock market investing. It's about the ironclad security of sticking with a government, military, or union job for decades to earn a guaranteed lifetime monthly check. Slow FIRE, on the flip side, is the exact opposite of that extreme frugality we talked about earlier. You only save 15 to 20% of your income, meaning you don't sacrifice your youth. You actually enjoy life along the way and realistically retire in your late 50s. It's a deeply reassuring, highly balanced, and totally sustainable approach. And then, way off the end of our standard timeline is fat FIRE. Guys, this is the absolute fantasy tier of early retirement. It's financial independence on steroids. We're talking discretionary spending of hundreds of thousands of dollars a year, first-class luxury travel, multi-million-dollar homes, Rolexes, you name it, whatever you want. But let's bring it back to the sheer mathematical reality for a second. To actually achieve fat FIRE, you need a portfolio of roughly $5 to $10 million. For a $100,000 a year earner, it's honestly highly unlikely to ever hit this within a 30-year time frame. Fat FIRE is generally reserved for extremely high-income earners, think specialized doctors, tech VPs, or successful business owners who cash out for millions. And there you have it, 15 radically different paths to the exact same goal. As you'll see, early retirement isn't some rigid rulebook. It's a highly customized journey of personal trade-offs. You can trade risk for time for comfort, or location for freedom. So looking at the timeline and all the choices we laid out today, I want you to ask yourself, based on your current lifestyle and your own goals, which strategy are you actually closest to?